equity mate.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast that follows our journey of investing. Whether you're an absolute beginner or approaching Warren Buffett status, our aim is to help break down your barriers from beginning to dividend. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. I am excited for this episode. You often tell me that you're a future global leader, and we've got two fund managers that want to invest in future global leaders. So I'm excited for you to convince them that you're worth investing in.
Yes, well, luckily the episode is nothing about that, Ren, but it is about global future leaders, and it is our pleasure to welcome back to Equity Mates for the second time James Abela and Maroun Younes to the studio. Welcome, boys.
Thank you.
Thanks, guys. Thanks for having us back.
So James and Maroun, if you remember them, joined us in October last year. They are both co-portfolio managers of Fidelity's Global Future Leaders Fund. And thank you to Fidelity for sponsoring this episode. And a reminder that Ren and I are not experts. We're not financial professionals. We're here just learning like you guys. But luckily, James and Maroun are experts. So we're going to be unpacking all things global future leaders, small caps, you name it, in this episode. So let's get stuck in.
Yeah, now James and Maroun, before we get to, your fund and what you're seeing in markets today, we want to start with a bit of a game. We're calling it this or that because we're not creative enough to come up with anything better. We'll throw out two choices. We want to know which you'd prefer. And I guess we just want to get a sense of your investing styles. So, James, why don't we start with you? Passive or active?
Well, definitely active for our world. That's the quick answer. But yeah, the key reason is just that couple of percent above the index over decades can mean a massive, massive difference. And we see it with people that we admire ourselves. And yeah, the index is, I guess, a cheaper way to play it. But that extra couple of percent, or even 2-3% a year compounded, can make a massive difference in someone's retirement.
Maroun, speaking of people you admire, not sure if either of these are in that camp for you, but Warren Buffett or Cathie Wood?
I would definitely have to say Warren Buffett.
Why is that?
Look, I think he's been able to do really good things for a long period of time. He's demonstrated that he can generate returns through different market cycles, and he's basically been doing it for decades. So he's not a one-trick pony. He's not only proven in one certain time period. I think he's sort of withstood the test of time.
Now that's an interesting one because Cathie Wood would definitely say she invests in future global leaders. So we'll come back to that one. But James, yeah. United States or the rest of the world, where would you rather invest?
Yeah, we're definitely US. All of it's based on the return on capital of the US market. It's just very strong. It's a very sophisticated market. It's a very high return market. It has a lot of opportunity. So a lot of them, do different states in the US and then just kind of take over the world once they've conquered the US. So yeah, we find the US incredibly attractive. About 66% of the fund is in the US today. And the rest of the world has, proven to be just more challenging overall. So whether it's regulation or return or market structures or management quality or governance, we end up favoring the US overall.
All right, Maroun, tough one here. Bitcoin or gold?
I'm going to have to go with gold at this point in time.
The lesser of two evils.
Yeah, look, I think both started off intending to be currencies, and then they've both sort of morphed into effectively being stores of value more than anything else.
Yeah.
But gold has been, a time-tested store of value for 6,000 years, whereas Bitcoin has sort of been around for about 15 odd years. So we're yet to sort of see Bitcoin handle crisis, act as a proper flight to safety in terms of store of value. So we'll have to go through a full market cycle with a nasty recession, I think, just to sort of see if Bitcoin can prove itself as a genuine store of value, or a digital form of gold.
And then last one, why don't we open it up to the floor and get both of your thoughts. For the passive parts of your portfolio, I know you guys are both active managers, but when you're talking passive, equal weighted or market cap weighted indexes?
Yeah, we actually go market cap equal weighted all the way, because for us, even the largest index position in our universe is around 50 basis points, which is really small relative to, say, the Australian market or most other markets in the world. The top 10 tend to dominate, 50, 60%. In our universe, the top 10 is about 3 or 4%. Maybe it's 5 when they get concentrated. But so we definitely do go. So we think absolutes. So when we have a position, we start at basically 1%, 2%, 3%. Things have risen to 4% in absolute terms. And yeah, the market weight is just it's the index. So we're definitely equal weight favored, and that's how we sort of see the world as well, an opportunity set.
Now, a lot has changed since we last spoke to you in October last year. So we'll crack into that in a moment. But before we do, for those that haven't listened to that episode, are you able to remind us about the Future Leaders Fund, starting with, I guess, defining what is a future leader and what does that mean for your investable universe?
Yeah, I mean, basically a future leader for us is a long-term, attractive, high-quality business. We want to invest in businesses that compound over a long period of time. So we look for businesses that can sort of grow. They not necessarily have to be high growth, but steady sort of growth over a long period of time. They have good margins, generate lots of free cash, really good rates of return. That's a sort of key metric for us. Ideally, we want them to possess good, strong balance sheets so they can withstand different stresses, and really be run by very capable managers and management teams. So they're the sorts of businesses that we define as future leaders, and they're the sorts of businesses that we want to partner up with over a long period of time.
So we've got a filtering process that we go through to kind of end up with those. There's 4,000 stocks in the universe, 1,000 in our index, and we're looking for the top 1 or 2%. So what Maroun said there, that's what we're trying to look for, and we're trying to get to the top 1 or 2%, which is a big step process, but that's critical.
Now, Maroun, I made a joke in the game at the start that Cathie Wood would also say she invests in future global leaders, and it would be maybe helpful for us to understand how you think differently to Cathie Wood, and maybe juxtapose, some of your top holdings against some of hers, because I imagine they're quite different. While she's got, Zoom, DocuSign, Teladoc, and Tesla, what are some of the companies that come to mind when you're thinking future global leaders?
Yeah, look, I think for us, future leaders, can take place in any industry. They don't necessarily have to be a technology-driven business. You can be a future leader in a very niche industrial segment, for example. Like let's say you make like a very niche sensor that gets used by airlines or gets used by OEM manufacturers for cars, etc., and you dominate that industry, and you do it really well, and you earn really good rates of return and generate good margins. So it's not necessarily a technology-driven business. You could be innovating in a particular service stream or something like that. So I think if you just look at technology and technology-driven businesses, then sort of I think that's sort of where you end up with sort of where Cathie is. We tend to be a bit broader in our definition of global future leaders, in that they could be dominant businesses. It could be a consumer brand, for example. So some of the companies, Moncler, for example, they do luxury winter wear. So if you've ever heard of Canadian Goose, for example, they're sort of like a higher end version of even Canadian Goose, and they sell thick bomber jackets for $4,000 or $5,000. And the emerging middle class, particularly in Asia and China, they go crazy over that, because that for them is a symbol of status. It's a symbol that it's an aspiration. You've made it. And so for us, that's a business that's growing over long term, but it's not really doing anything fancy in terms of new technology or saving the universe. But it still is a global future leader in our eyes. So I think that's sort of the key difference in terms of how we define it more broadly. And I think Cathie's just sort of looking a lot narrower and a lot more specialized in sort of the technology-driven world.
Disruption.
And what we look for, we tend to probably place a bit more emphasis, I would say, on the here and now. I think Cathie's sort of looking further out, 10 years from now. We generally have been avoiding concept stocks or loss-making stocks. We actually want businesses that have an existing proven business model and that can continue to grow in the future, not just sort of pinning everything on the future and sort of the revolution of the future, I guess.
It's a novel concept, existing proven business models.
You guys aren't in on the meme stocks, or
no meme stocks for us. No. So you got to just touch on maybe the top 10, because that's.
Yeah, I mean, our top 10, like we've got top 10 holdings in stuff like energy, insurance, technology, consumer. So it really is sort of widespread. Healthcare, we've got a couple of names in healthcare. So it really is sort of widespread. Some are sort of household names, some are sort of more B2B players.
That's business to business.
Yeah, sorry, business to business. But they're all very good at what they do, and they all dominate what they do quite well.
So we're almost a year since we last spoke, and there's no question that plenty has changed over that past 12 months. So how would you sum up the year that has been, and I guess from the point of view of the top 10 holdings, how have some of those companies held up? How have you been managing the portfolio?
Yeah, no, it's a really big change. So the last 12 months, a lot has changed. I guess we could say the situation now is very different to the last 10 years. So a very significant compounding effect of the current challenges: rising inflation, rising interest rates, lower market liquidity, lower valuations, much higher investor skepticism, tighter labour markets, much global pressures from higher expectations in like ESG, environmental, social governance behaviours within organisation. So it's been a very volatile period for the world to just absorb all those concepts in their head and markets. It's been very volatile. So the top 10 actually probably hasn't even changed that much. The last 12 months, it really hasn't moved. The companies that we own are still doing quite well. As Maroun mentioned, we've got technology companies, energy companies, consumer companies, and some industrials that have still done quite well. But all those conditions have put extreme pressure on margins. We can touch on later sort of how we think about the portfolio, but it's really the market structure that you've got to think about, because whether the companies that you own can hold all those pressures in their businesses and actually maintain margins actually comes down to the ecosystem that they operate in. And if that ecosystem is highly competitive and it can't hold the margins, there's a lot of profit warnings already coming from Europe, and now just starting in America, but Europe in particular, because of the energy crisis and the cost of living crisis. But as these pressures intensify over the next 12 months, the market structures and ecosystems that companies operate is what you've really got to think about. And that's, I think, where this environment is actually very different to 12 months ago, but it's also very different to what it was over the last decade, because rates have gone up significantly. So the sort of hurdles on companies and what they have to sort of jump over in order to make their margins and maintain margins is really high compared to what it was 12 months ago. And all those COVID conditions, which was free money and huge government support, a lot of that's gone. So companies are very much faced with the ecosystem they operate, how much their product is loved, how much does the businesses that they're supplying to need them, how critical is that application. If it's not mission critical, then there's not huge customer love in terms of, I need to have this product as an aspiration. They're under a lot of pressure.
I guess in broad strokes, there's sort of three options that you have as fund managers in a downturn. You can go to cash. You can sell some positions and go to cash. You can turn defensive and invest in different positions or go short the market, or you can hold strong and keep buying more or stick to your original positions. How have you guys thought about navigating the last 12 months, and I guess which bucket would you put yourselves in?
Yeah, Maroun.
Which bucket? Look, it's probably a combination of all of them. I think if you sort of just rely on one or the other, you're sort of not utilizing all the tools. So, we do focus predominantly on quality business models, high quality franchises. James said, generally businesses that have good pricing power, for example. So that means if it's fears about inflation, which we've sort of had, these businesses can sort of hold some of their margin. If it's fears around recession, again, if you're providing a product or service that's necessary for your customers rather than sort of a nice to have, then your revenues tend to be stickier. So I think if you gravitate towards quality as a starting point, it gives you some of that defensive characteristics that you look for in down markets. And so you're already positioned there without even needing to sort of sell and sort of go defensive anyway, because those businesses themselves exhibit some of that inherent defensiveness anyway in their own business model. So
that's half of our portfolio is currently what we consider to be quality, and the rest is other cyclicals, defensives, special situations, value stocks.
Yeah. So I think that was sort of like a key thing for us. The other thing that has sort of been really helpful for us is, again, sort of going back to inflation, and inflation fears probably started to surface about 12 months ago. Because we have a valuation discipline, at that point in time, energy was an area probably about 18 months ago that we were attracted to, because energy had sort of been left behind. If you sort of remember, there was all sort of the COVID winners, and it was stuff like Zoom and DocuSign and Peloton, and all those things sort of went crazy. And there was a whole bunch of, I guess, old economy areas such as energy, which had sort of been left behind,
forgotten,
and they didn't get caught up in any of the meme stock manias. So energy was one that we were attracted to, because it's sort of been left behind, and there was really good pockets of value there. And so we started to build up a position in that probably 18 months ago. And then inflation fears started to pick up maybe 12 months ago, and that was positive for inflation. And then you had sort of Russia invading Ukraine and all the sanctions on Russia, by the Western world. And Russia is a big exporter of energy, and that's sort of given energy another shot in the arm. So we were also sort of, fortuitous to sort of have that energy position there. So we haven't really had to do a whole lot in terms of like wholesale chopping and changing. I think we've sort of largely stuck to our core, but part of our core, I think, gives us that inherent protection anyway, by focusing both on quality businesses, and also having like a robust valuation discipline, and not paying up for the best stories, and paying whatever multiple the market is putting on, but rather sort of going back and saying, how much do we think this is worth? It might be a great story, but how much do we think this is worth? And if it's trading, for less than what we think it's worth, then we'll buy in. And if it's trading at, much higher valuation than what we think it's worth, then we'll sort of leave it alone, even if it has the sexiest story out there.
If only I was in on the energy trade 12 months ago.
Yeah, we bought a stock called Cheniere Energy, and it actually wasn't making money when we bought it. And the analyst said to us, over the next 2 years, they're going to release trains, as in like a whole, a stream of LNG. And the LNG price went vertical. And that stock has gone up, sort of two to three times over the last 18 months. And that's been phenomenal. And, I was reading about them recently, and like they're exporting a lot of LNG to Europe to try to solve the European gas issues. And they've become a critical part of, the solution of that now. So, but energy's been great. And like Maroun said, it was a very forgotten sector. So we thought of it as value. And now it's, probably more momentum-y, but it's still very, very cheap as a sector. So we're still overweight and still like it.
So you'll take a value. Yeah, I'm interested in that comment where you said you bought it when it wasn't making any money, and just where that kind of fits into the process of finding and uncovering these gems. There's been plenty of businesses over the last 10 years who have been telling us that, they are future leaders, putting a lot of spin, and now they're trying to tell us that they're all solvent and it's all good. So just kind of wondering how you do look through that sort of marketing spin, identify some of the true gems. I'll
just touch it on Cheniere is really like looking out 2 to 3 years, which was the release of the LNG gas. Maroun can touch on a lot of the tech ones, because we dodged a lot of trouble in tech, which was really cool stuff that was loss making and crazy sort of sales valuations. But specifically on energy and other sort of industrials, which were really cheap. We just looked at what was happening over the next 2 years. Valuations are very attractive. Analysts were really positive internally. They knew what the outlook was, and we did move into them, and that was energy and some industrials. But Maroun can sort of talk about the tech ones, which there's a lot of sort of dodging those and not owning them, because a lot of them were great stories that traded on sales multiples, but we didn't own a lot of them, right?
So I think the key for us is really, it comes back to our process, and we have a very sort of robust and diligent process that we always follow. And so we sort of look at various different aspects. We look at businesses, through multiple pillars. There's three of them. There's one that's viability, which is effectively more sort of the here and the now. So the margins, the return profiles, how viable is the business. Another pillar is the sustainability, which is, how sustainable are these going forward? So you could be earning really high margins today, really good returns, but you see a wall of competition coming on into your space. And so you sort of look out and you go, these margins and returns are not sustainable, 5 years into the future. Or it could be the other way around, where you're not earning a whole lot now for whatever reason. Maybe you're reinvesting quite a lot right now, but you can sort of see that, those numbers. So the viability is sort of looking more at the here and now. Sustainability is sort of looking at that profile over the next few years. And then credibility really is sort of like our conviction in management teams and the accounts and things like that. Yeah. So the process, I think, for us weeds out a lot of those things, because you could be doing something that's super cool today, but again, if it's not, if there's no competitive advantage, if there's no sort of unique angle to what you do that's going to protect you in the future, it's very hard for us to buy in. So, Peloton, for example, let's take Peloton. I mean, look, it was a novel concept, for example, but ultimately it is a hyped up home exercise routine, right? And it is jazzed up with sort of like an iPad, and you can do all different sort of biking circuits and all sorts of different things. But ultimately, it is a home workout session. So firstly, it's very easy to get into, right? Lots of people have been doing sort of home workout sessions, whether it's sort of aerobics or sort of a shadow boxing or anything of that nature. There's different ways of being able to exercise at home. The other thing as well is exercising at home was elevated during COVID because you couldn't actually go out. In a more normalized post-COVID world, sure, there'll be a lot of exercise at home, but it's probably not going to be as elevated and as heightened as when everyone, 7 billion people, were locked down in their homes pretty much all around the world at one point in time. So being able to look out and sort of look at the business model and how they make money and say, is there something unique about these guys, or can they be competed away? Can other home stationary bike manufacturers get into this market? Absolutely. Can others generate a lot of hype and a lot of marketing spin around how unique their service offering is? Absolutely. And so for us, something like that just didn't look like it was genuinely sustainable going forward. And so I think, again, it sort of comes back to the process and just being able to see just how defensible those sorts of business models are.
Yeah, so definitely we've seen those days of sort of storytelling and narratives and momentum clusters that trade on big sales multiples performing well and getting a lot of market support. So really high valuations, they could raise money overnight. Those sort of days, really are behind us. And now, and what we do as a Maroons at a high level, we look at cash flows, we look at profits, we look at sustainable margins. Can they manage the cycle? Can they access and price debt very reasonably? And we look at all of those really closely. And we looked at a lot of these tech bubble sort of stocks that happened during COVID or work from home COVID bubbles, and concept stocks that just didn't make money but sounded really, really good and were absolutely booming 2 years ago. And our view is, as we move through to 2023, a lot of these pressures that we talked about in terms of costs are going to start to flow through, so into the consumer, into corporates, into margins, and that's why you need to be, I think, even more diligent today than normal, because this is it's going to be a pretty challenging, likely 6 to 12 months. And stories and narratives and little momentum clusters are not the things you want to be chasing.
Yeah, going back to that Peloton example, I think if there's one lesson I've taken from 2022, it's that I will never invest in fitness. Well, I was about to say again, but I haven't invested in fitness. But Peloton and F45, two of the most hyped up stocks of the past few years. And now we're seeing there's a bit of noise around Facebook's VR fitness experience, and they're trying to acquire a company that's a leader in VR fitness. And there's a bit of hype that you're starting to see in that community around the, fitness being the use case for VR. After gaming, it's going to be like the next big use case. I'm staying away. I've learned 2022 has taught me, don't invest in fitness because it's all just fads.
Yeah, it is hard. Like, it's the barriers to entry are just so small. Like we looked at Peloton like twice, and we spent like half an hour on it. Looked at it in detail. We debated it amongst ourselves. We looked at the competition, and the competition came. Amazon, a lot of different competitors. And if the barriers are low, like eventually you will get competed away. So, but yeah, fitness has been, and we looked at F45 as well. That was sort of pitched to us, and we thought, okay, we'll have a look. And yeah, you're right. Fitness has been really tough. And it's globally, fitness has been really tough. No one's really kind of cracked that market to make it really competitive, and make it a sustainable margin. So, not an easy one.
So, if we can just go back to your, I guess your framework for looking at stocks, viability, sustainability, credibility. I really like how succinct that is. And then, so once a company passes those three, I guess, threshold tests or whatever you call them, it's then you were speaking before, Maroun, about valuation discipline, and only energy came up on your screen 18 months ago because the companies that had passed those three tests were also looking cheap. So I guess the question is, if energy came up on your screen 18 months ago, and we've seen what happened to energy since, what's the sector that's coming up on your screen today?
Yeah, look, there's probably not a sector in general that's screening right now. We are looking for specific things, and I think it's just a function of where we are in the macro right now. So it's less about the valuation per se, and it's more about just navigating what we think might be a very tricky and vulnerable window over the next 6 to 12 months. So it all really stems from, I guess, from inflation and central banks around the world, particularly in the US. They're very firm about sort of bringing inflation back under control, and all the recent commentary is that, particularly in the Fed, they're willing to tolerate some economic pain to sort of bring inflation under control. So that sort of brings about two things that we're looking for. One is businesses that can protect their, I guess, margins and profits during inflationary periods. And the second thing is businesses that can be resilient during, soft economic times. So they're the things that we're really looking for now, as opposed to sort of just looking for something that's necessarily cheap. So I think for us, first and foremost, is finding those characteristics or businesses that exhibit those characteristics that we think will be good places to navigate the next sort of 6 to 9 months. And so, again, a lot of it is very company specific, but I'd say one area that we did go into probably about 6 to 9 months ago was insurance. We sort of built up a position in insurance, and there's a couple of reasons why. I think insurance, they operate on their own cycle, which is independent of the economic cycle. So insurers, when they receive, like if you're a property insurer and you go through a flood season, for example, like what we just had, along the East Coast last summer, what then insurers do is actually reprice upwards their premiums for the following year to sort of make back some of those losses. So you have these cycles that usually go for about 2 or 3 years in each direction in insurance, and hardening is sort of when insurance premiums are going up, and we've been sort of seeing that. So you've got premiums that are going up independent of the economic cycle, and insurance is not something, by the way, that you can just stop having just because you're not being paid a bonus, right? Like your house needs to be insured, life insurance. If you're a business, you need to have insurance to be able to operate. So if your revenues are down 10%, you're still going to insure your business anyway, because it's it's just the cost of doing business. So it's very sticky. It's independent of the economic cycle, and it's been going up. The other thing about insurers is they collect your money up front. So you think about, you pay for your home and contents or your car insurance, you pay the premium up front, the company gets that, and basically they're liable to pay you out any course over the next 12 months if you make a claim. So basically they've received your money up front. They have free reign to do whatever they want with that money for the next 12 months, because it's technically a liability for them, a contingent liability. It's unearned income that sits on their balance sheet. And only when that policy, let's say it's 12 months, only when that policy expires that it genuinely becomes theirs. Now, what they do with that is they usually invest in very short-term fixed income securities. So usually like 3 months or 6 months or 12 months fixed income securities. 3 years ago, they were getting very little by way of yields on those investments, right? Because interest rates are quite low. Now interest rates are going up, and so people like insurers who invest in sort of short-dated fixed income now can earn money on that premium that you pay for them in advance, 12 months in advance. They can earn some extra money on that they weren't earning 2 years ago. So they've got more money coming in via their premium prices going up. They've got more money coming in via their investments. And it's a very sticky and resilient business, and they generate a lot of free cash. So that was an area for us that we found quite attractive, and we sort of bought a few names in that space, and it's actually done quite well for us over the past sort of 6 months or so. But outside of that, it's really hard to sort of categorize and say one sector is sort of the one that's flashing for us that this is sort of where we need to be right now.
Super interesting. So, Maroun, you mentioned there sort of the next 6 to 9 months and a few of the macro headwinds that we're facing into. No doubt inflation seems to be a little bit more persistent than the market would like. Interest rates looks like they're going to be raised at a rate again that the market is a bit uncomfortable with. Fear of recession, plenty going on. What do you guys see as the risks moving forward from a macro point of view? What are you paying closest attention to if you kind of had to choose one or two?
Look, I think the risks are high and they're increasing. I think, like I said, it all comes down to inflation. I think inflation was or fear of inflation was the first thing that surfaced probably about 12 months ago. Interest rates or yields started to pick up on the back of that market, expecting interest rates to go up. And then central banks have been very aggressive in pushing up interest rates, and not only aggressive in their actions, but also aggressive in their wording. Like, what I'm referencing there, there was a Jackson Hole speech a couple of weeks ago by the US Fed, where basically the chairman said that they're willing to tolerate an increase in unemployment and, a softening of the economy to sort of achieve their inflation objectives. So you've got unemployment at 3.5%. Who knows what they're willing to tolerate? But 5 or 6%, sounds reasonable if you sort of use that language. So they're basically okay with unemployment picking up another, 50% from where it is today, from 3.5 to 5 and a bit, I would say, because they really want to fight inflation. And so I think the best outcome, the most ideal outcome, is what's sort of often referred to as a soft landing, where you raise interest rates high enough that you cool inflation, and then economic growth slows down, but it stays positive. So it goes from, say, +4 to +2 or +1, but it stays positive, and that's what's known as a soft landing. The alternative is a hard landing, where you raise interest rates so high that actually economic growth turns negative and we enter a recession. And then unemployment goes up and corporate bankruptcies go up and mortgage default rates go up and everything that's nasty goes up. And the concerning thing about that is we don't really have a good track record, because I think over the last 60 or so years, 70 years, we've only engineered about 2 or 3, if I'm not mistaken, soft landings. And we've had a whole lot more by way of hard landings and
control inflation.
To control inflation.
Yeah.
And there was another stat I sort of read the other day where inflation has never gone above 5% and been tamed without a recession. And inflation in the US now is sort of running with an 8 handle. So if we're able to tame inflation without a recession, it'll be the first time, I guess, of the last 100 years. So when you look at that and you go, the odds are not in our favor of being able to sort of pull this off without, causing a lot of pain. We may, but the odds just aren't there. So I think for us, that's why, things about resilient businesses and businesses that can protect themselves during inflation have been such a prominent feature of what we're looking for over the past, 6 to 12 months. It's because, like, we look out there and we sort of see this looming. We don't like the look and smell of it. And so we're just trying to, make sure that we get set up from now, that if something sort of breaks, I guess in the near future, we're sort of set for that, rather than sort of scrambling behind the 8 ball and trying to get set, at that point in time.
So we between us have been talking about the words persistency and consistency. So at the moment, basically, growth certainty and yield are becoming scarce again. So I think there's a premium that's going to come into the market where if you can provide growth, certainty and yield, then that's going to be okay. But when we think about picking stocks, it's all about the persistency of the return profile. Can you hold it, basically? And that's what we talk about ourselves whenever we buy something new or whenever we're reassessing the portfolio. We're thinking about those words: persistency, consistency, visibility, and that's really where that sort of strength and a big chunk of the portfolio, half its quality, and then the rest of them, we want to make sure they still have those attributes that Maroun mentioned before.
So when we talk about macro, we often talk about we talk about it globally, and that makes sense because the economy is so interconnected and globalized. And we all look to Jackson Hole, and we all look to the U.S. Federal Reserve and what they're saying and what they're doing. But we are also seeing, I guess, some more localized issues. We're seeing Europe face into an energy crisis. We're seeing China face into a property and mortgage debt crisis. On a, I guess, regional level, or even on a sector by sector, industry by industry level, is there anything that you've just put any countries or any industries that you've just put a black line through and you said, for the next 18 months, we're not touching this, we'll come back to it when things start to improve?
Yeah, I mean, there's a few. I would say less country and more specific areas. So I think yields going up, rates going up. That's putting pressure on valuation. So you don't want exposure to businesses where a lot of the valuation resides in the future. So what's known as long duration. So anything that's loss making, or anything that's super expensive, 50, 60, 70 times PE. We're trying to stay away from because they're very, very sensitive to tiny changes, tiny increases in interest rates. They've come off a long way over the past 6 or 9 months, but I don't think we're completely out of the woods yet in terms of that vulnerability to interest rates. So we're really trying to stay clear from that. We're trying to steer clear, as James said earlier, about businesses that are sort of in very super competitive or commoditized industries where they have no pricing power, for example, because we sort of see inflation, we see the pressures that are going to businesses are going to have to face on their margins. And if you're one of 10,000 different Me Too providers that do the exact same thing, then you're not going to be able to put through pricing. We want businesses that are very unique in what they do and that can sort of get inflation protection. And then we're staying away, I guess, also from businesses that are heavily leveraged. Because if we do enter a recession, having a lot of debt on the balance sheet decreases your chances of surviving. And B, increased funding costs, and these businesses that have a lot of debt are going to face pressures to their bottom line via increased debt costs. So I think these are areas that we're really trying to stay away from. And so rather than looking at it by sector or by geography, we're looking for attributes that we really don't want at this point in time and ruling businesses out. But based on that, and also businesses that are very cyclical, right? Because they're exposed to the economy. So anything that's heavily cyclical, where if economic growth goes down, these go down even further. Again, we're trying to stay away from them, really looking for businesses that are, I guess, stickier or more resilient.
Yeah, but definitely like what you mentioned, like Europe, we have lower exposure. The US, we have a lot of exposure. Japan, we have a very, very low level of exposure because the ROEs are very low overall. So, Europe, we are very cautious. I think European recession is something that the market's basically thinking is quite certain for next year. And consumer weakness globally is something that people think is pretty much given. So they're definitely things that we think. Therefore, I think, what do you go to? As Maroun mentioned, something unique, but also things that there's a high element of trust. So if it's in engineering or healthcare or privacy or finance, if there's an element of trust and respect and aspiration, like whatever happens in geopolitics or the market or inflation, those things are still going to need to be there, right? They don't move. Human desire for trust and respect and aspiration still exist in our heads. And it's still a desire, and especially if you need a product like insurance or engineering or healthcare, the trust element is something that takes decades to build, and it can't be manufactured or it can't be competed away. It takes many, many decades. So for us, that's kind of where we've gone to. So most of the top 10, they either produce something that's quite unique, or they've got a business where there's an element of trust, whether it's a small component in a big process, a small share of wallet in a big process, or something that's aspirational. So I think if you think about sort of where you don't want to go, it almost tells you where you do want to go. So I think that's sort of the, there's two sides to it. And I think that's sort of where we've gone to, because there's so much that I guess, there's a lot that you don't want to own in this market and in this environment that is very, very, very pressuring for companies. So therefore, the ones that you want to own, it's probably a smaller opportunity set than normal over the next 12 months. But if those can hold their own, then it's really exciting to own those stocks.
Well, speaking of where you do want to go and where you don't want to go, I think to close out the episode, it would be great to hear where you both are going. And if you could perhaps provide one company each that is a good demonstration of everything that we've kind of discussed today, in terms of your investing universe and the companies that are really exciting you at the moment. So, Maroun, maybe we start with you. If there's one company that, you could let us know, that'd be awesome.
Yeah. So one company I'll sort of put forward today is called Arista Networks. They make network switches, which for those that don't know, if you have like different devices connected in a network. So let's say you're at work and everyone's got different sort of computers and they're all connected at work and they can all sort of share files and work on similar files. In the back end, there's a piece of hardware called network switches where they're all sort of plugged into that, and that sort of facilitates the transfer of data from one computer to another within the network. They're a leader in that. There's two other big players in there, Cisco and Juniper, along with Arista. Where Arista is growing quite a lot is in the cloud space. If you sort of think about data centers where all the clouds are hosted, there's lots of different devices sort of talking to each other there. Arista's two biggest customers are Facebook and Microsoft. So Microsoft has got Azure, so you can sort of use Azure as like a competitor to Amazon's AWS. So you could sort of host all of your, if you're a small SME, you can host all of your network on the cloud. You can use someone like Microsoft. Facebook obviously are hosting all of their content, right? All the videos, all the photos. They sort of need to host that on their cloud. They don't really offer it as a third party solution, but they're the two biggest customers. Obviously cloud is growing strongly and will sort of continue to grow. So the industry itself has got that nice growth tailwind behind it. Arista, I think, has increased its revenues 15-fold over the last decade. So it's grown like a weed. We continue to expect that it should be able to grow, low double-digit growth rates, for the next few years going forward. Generate really good margins, really good returns, sort of north of 20% return on equity. Generates free cash, and they use that to sort of fund buybacks. And the management team is well regarded. So the co-founder of Arista, he co-founded a company called Sun Microsystems, which was bought out by Oracle many years ago for a few $1 billion. He co-founded a company called Granite Systems, which was bought out by Cisco. He was one of the first investors in Google. He actually gave the Google founders, Larry Page and Sergey Brin, $100,000 check himself personally. He was one of the first investors in that. So he's got this legendary status within Silicon Valley. The CEO, similar thing. She's had a decorated career at AMD, at Fairchild. She was at Cisco, and she's been there for 15 years. So they have a very well-regarded management team. So I think it sort of ticks all those boxes. Long-term quality compounder, does really well, dominates its segment. It's growing nicely, good margins. So there's nothing not to like about Arista.
Yeah, I've just Googled the company while you were talking about it. It's up 30% this year, which is rare to see. Company up in the past 12 months. For people playing along at home, trading in New York, stock ticker ANET. Remember to do your own research and make your own investment decisions. But Fascinating company I hadn't heard of, and one that I'll definitely do more research on. So James Maroun has set the bar pretty high there. Do you do you have a company that comes to mind?
Yes, it's a little bit. Look, it's very stable as well, and really fascinating. Also, the big thing is a long-term quality compounder like Arista. A very obviously different world, but it's in insurance. One that we've spoken about on this episode. It's Arthur J. Gallagher, code AJGUS. It is an insurance business, provides insurance broking, consulting, third-party settlement claims, and admin to basically a lot of companies all around the world. It's also very ethical. Like, this is one of the top 100 most ethical companies in the world. It's a real sort of one of these what we call a beautiful compounder. Has really strong returns. Strong sustainability, really strong processes, market structures. It's like admired and respected as one of the insurance companies in the world. Credibility is also very high, as I mentioned, in terms of the accounts and management. And as I said, have voted one of the top 100 most ethical companies in the world and most desirable places sort of to work. So Arthur J. Gallagher is one, and we've spoke about insurance. I was the financials analyst for Australia in the financial crisis in 2009. And during that period worked out that insurance companies make three margins. One is the insurance margins, one is return on shareholders' funds, and one is return on what's called tech reserves. And when you're making the triple benefit of that upswing in terms of the upcycle in insurance, these stocks are really, really good places to be. So the capital, I guess, is being sort of removed out of the system in terms of capital liquidity. So hedge funds, a lot of them are removing capital out of the insurance system, that when you've got declining rates or cheap money, a lot of capital goes into the insurance industry. But now the price of risk and the price of capital and the attitude towards risk is definitely becoming a lot harder. And that's why the insurance industry is going through that hardening cycle. But the benefit of rising rates is they get better return on shareholders' funds, better return on tech reserves. And this business is a distributor of insurance as well. So you're getting all of these sort of positive tailwinds that you're getting from the industry perspective as well. So yeah, we like it. It's in our top 10, but it's in a great part of the cycle. But yeah, a great long-term compounder.
Love it. Well, Maroun and James, it's been an absolute pleasure chatting this afternoon. We can't leave the call, though, without letting everyone know the exciting news that you will both be appearing live in person at FinFest here in Sydney on October the 15th, sharing all your wisdom on all things future leaders. So we're excited. We're actually facilitating that conversation.
Oh, so that's when you convince these guys that you're a global future leader.
Yes, that's a 25-minute pitch session from me. So on the main stage, Stake main stage, which we're really pumped about, mid-afternoon, I think. So everyone's going to be nice and lubricated. It's going to be fun. But it's if you haven't got your tickets and you'd like to come and meet James and Maroun in person and have a chat to them and get to many stock tips from them off record, then you know the place, equitymates.com/finfest. But gents, it's been an absolute pleasure as always. We always take so much information from you in these conversations, and I'm sure the Equity Mates community have as well. And we look forward to catching up with you in a couple of weeks' time.
Great. Thank you very much.
Good. We're super excited for that, and thanks for having us again, guys.
Yeah.
Always a pleasure.
Thanks, guys. We should also say that if you can't wait until the 15th of October to hear more from James and Maroun, go to fidelity.com.au. It's more information on their fund and more information that they've written as well.
Nice. Well played.
Plenty of James and Maroun content.
Thanks, guys.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.